It's always fascinating when a company gears up to go public, suddenly this S1 filing drops, and bam, they have to lay out everything.
It's true. All the financials, the strategy,
Mhm.
even the potential problems. It's like a peek behind the curtain you don't normally get.
Absolutely. A
Yeah.
real treasure trove for anyone interested. And today, we are diving headfirst into one of those, the S1 from Chime, the fintech focused on, as they say, everyday Americans.
Right. And, no company operates in a bubble, especially not in fintech. So Chime's S1 actually mentions competitors, which is helpful. We're pulling in a few key bits from SoFi's latest 10K just to give that competitive flavor, that context.
Exactly. So our mission today, we're going to try and cut through all the dense language in these filings, pull out the really juicy insights.
The key numbers, the strategy, the big risks, basically translate the corporate speak.
Yeah, translate it so you listening can get a really solid handle on what Chime is about and the world it's operating in. Think of it as your shortcut to being properly informed.
Okay, so where should we start? The S1 itself, right? Who Chime is actually for.
Perfect. Let's unpack that first. The S1 is pretty specific, isn't it?
Very. They define their target market clearly. Everyday Americans earning up to $100,000 annually.
And that's a massive group of people. They say 196 million, over 75% of U.S. adults. But there's a key financial behavior twist in the S1, right?
There is. They point out this group holds less than 35% of consumer deposits, but, and this is the kicker, they drive over 75% of debit card transaction volume.
Wow. Okay, so it's not about attracting huge savings accounts. It's about capturing all those swipes, that day-to-day spending activity.
Exactly. And the S1 even gives them some character, calls them ambitious, resilient, and hustle. Kind of paints a picture.
It does. And setting
Totally.
the stage like that leads right into their core philosophy, which they state pretty boldly. We believe in free.
Yeah, and they draw a contrast with what they call high-cost providers. Their pitch is low or no fees.
So that means no overdraft fees with SpotMe, no insufficient funds fees, no monthly fees, plus access to 45,000 fee-free ATMs. Those little fees can really add up for people.
They absolutely can. And the key to making their model work, according to the S1, is getting that primary account relationship.
Meaning they want to be the main place people deposit their paychecks, right? Their financial hub.
Precisely. Get the direct deposit, become the default card.
So how's that strategy playing out? Does the S1 give us numbers?
It suggests it's working pretty well. They talk about deep and habitual engagement, becoming the top of wallet card. The stats are interesting. Q1 2025, active members average 54 transactions a month.
54.
A month?
Yeah, and 75% of those were purchase transactions, so lots of active spending.
That's way more than I do, I think.
Yeah.
And the S1 mentions getting paid up to 2 days early with direct deposit. That seems like a huge draw for this audience.
Oh, definitely. Getting access to your money even a little sooner, that can make a real difference for managing cash flow week to week. Okay, so you've got high engagement, lots of transactions, and this free philosophy. But how do they actually make money then, if it's all free?
Well, the S1 lays that out. The main engine is payments revenue, specifically interchange fees.
Interchange. Explain that simply.
Okay, so when you use your Chime card debit or credit, the merchant pays a small fee. That fee goes to the card network and the issuing bank. Chime's bank partners collect those fees, and then they pass a share of that back to Chime.
Got it. So the more swipes, the more transactions, the more revenue for Chime. It's a volume game.
Exactly. It's all about that transaction volume. And they also emphasize driving more revenue per user over time by getting them to adopt more products.
Like beyond just the basic checking account and debit card.
Yes. The S1 notes that back in March 2025, the average active member was using about 3.3 Chime products, and their average revenue per active member ARPM was $251 for Q1 2025.
$251 per member per quarter. Okay, but what happens if someone uses loads of their products?
Well, that's where the S1 highlights a really interesting multiplier effect. Members using 6 or more products generated 1.8 times more ARPM in that same quarter.
1.8 times.
Ah.
So nearly double the revenue from their most engaged users.
Right. It suggests that getting people deeper into the ecosystem isn't just incremental revenue. It creates a significantly more valuable customer. A stickier one, too, probably.
That makes sense. More products, more potential transaction points, maybe credit usage. It feeds the whole model.
Exactly. And some of those additional products are things like SpotMe and MyPay, their liquidity features. The S1 gives details on those, too.
SpotMe, that's the fee-free overdraft thing, right?
It is, and it's used a lot. The S1 says members got $43.3 billion in fee-free overdraft via SpotMe since it fully launched in 2019. They also make a point of saying the optional tip feature is completely optional and doesn't affect your limits.
Good to clarify that. And My Pay, that's the early wage access.
Yeah, access up to $500 of earned pay before payday. The S1 says members accessed $8.8 billion through it by the end of March 2025.
Another huge number. There's a stat in the S1 about its impact that really caught my eye. Something about payday lenders.
Oh, yeah, that was striking. They reported that 87% of MyPay users who used to use payday lenders either stopped completely or cut back significantly after using MyPay.
87%. That's
Oh,
was a powerful claim about disrupting those high-cost alternatives. It really speaks to meeting a need for their target user.
it certainly suggests the product resonates and offers a tangible benefit compared to older options.
Okay, so they're engaging users, getting them to use multiple products. What about keeping them long-term? And are these users profitable over time?
The S1 talks about sustained transaction profit each year for member cohorts, and retention looks solid. They quote around 90% annual retention for members after their first year.
90% is strong, but you flag something else. Net dollar transaction profit retention.
Ah, yes, that 104% figure for the year ending March 31st, 2025. This is really important. It means that the group of existing members from the previous year didn't just stay. They generated about 4% more transaction profit for Chime.
So their existing customers are becoming more valuable over time, not less. That's a really positive sign for the underlying business model.
It absolutely is. It shows the engine isn't just reliant on constantly finding new users. The ones they have are growing in value, which probably ties into their tech platform efficiency too.
Right, the S1 mentions big investments there. Cloud-native tech, something called Chime Core.
Yeah, their proprietary processor and ledger, plus data and AI platforms, they built a lot in-house.
And they claim some serious results from that tech investment in the S1.
They do, like a 60% drop in support costs per active member between 2022 and Q1 2025, and a 29% reduction in fraud loss rates over that same period.
Whoa, 60% cost cut on support while growing. That's significant operational leverage.
It really is. And they also mentioned boosting automated support. 68% of interactions handled that way in Q1 2025. But here's the impressive part they highlight.
Go on.
Despite all that automation and cost cutting, they apparently doubled member support satisfaction scores from Q1 2022 to Q1 2025.
Okay, that's the kicker. They cut costs and seemingly made customers happier with support. Well, that's the dream, isn't it?
It suggests they manage that balance really effectively. And, being digital first without the massive overhead of physical branches is obviously core to that whole low-cost model.
All right, let's get to the brass tacks then. The overall financials from the S1. How does this strategy look on the bottom line?
Well, the revenue trend is clearly upward. $1 billion in 2022, $1.3 billion in 2023, then $1.7 billion in 2024.
Okay, steady growth and gross profit.
Following suit, $794 million in 2022, growing to $1.06 billion in 2023, and $1.47 billion in 2024. So those gross margins seem pretty healthy.
But what about net income? They've been known for losses historically.
Right, and the S1 shows that journey. A net loss of $470 million in 2022, shrinking to $203 million in 2023, and then getting really close, just a $25 million loss in 2024.
Almost there. And did they cross the line recently?
They did, according to the quarterly data shown, net income of $15.9 million in Q1 2024 and $12.9 million in Q1 2025. So yeah, they've recently tipped into profitability based on these numbers.
That's a significant milestone. Looking at the expenses, though, sales and marketing seems substantial, and transaction and risk losses jumped quite a bit too, right? From like $126 million to $220 million between 22 and 24.
Yeah, those are inherent costs. Acquiring millions of members cost money, that's sales and marketing. And offering overdraft protection and early wage access involves risk, that's transaction and risk losses. It's part of the cost of doing business for this model.
Makes sense. Now, an S1 isn't just the good news. It's legally required to lay out the risks. And Chime lists some pretty big ones.
Oh, absolutely. It's a critical section. And maybe the most fundamental one they flag is their dependence on bank partners.
The Bancorp Bank and Stride Bank. Why is that dependency such a major risk?
Because Chime isn't technically a bank itself. They need these partners to hold deposits, issue the cards, provide the actual banking services. The S1 is blunt. If those relationships go sour or if the banks hit regulatory trouble,
then Chime has a huge problem.
Exactly. It could mean service disruptions, huge costs to switch partners, and serious brand damage. It's a major structural reliance.
Kind of like a single point of failure, but multiplied by 2. What else?
Well, related to their core revenue, interchange fees, any significant changes to interchange regulations or fee structures from the card networks could directly hit their main income stream hard.
And regulation generally seems like a big cloud. They specifically call out the CFPB, the Consumer Financial Protection Bureau.
Yes, they note the CFPB has significant authority, and there's uncertainty about future actions. Tied into that is this concept they mentioned, the true lender risk.
True lender, what's that about?
It's the risk that regulators might decide that Chime itself, not its bank partner, is the actual entity lending money for certain products, like their instant loans.
And if that happens,
Then Chime could suddenly find itself subject to all sorts of state-level lending laws, which are complex and vary everywhere. It could mean penalties, needing licenses, maybe having to change products. It's a significant legal and operational risk.
wow, okay. That sounds potentially very complicated. Any other big risks jump out?
Reliance on third parties is another one. Not just the banks, but vendors for fraud detection, marketing tech, cloud infrastructure like AWS or Google Cloud. If any of those key vendors have issues, outages, security breaches, it impacts Chime directly.
Right. And competition, obviously. They list the big traditional banks, the online banks like Ally, and other big fintechs, PayPal, Cash App, Affirm.
It's a very crowded space. The S1 acknowledges that intense competition. Plus, the usual risks for a growing company. Their financial estimates might be off. They have a relatively limited operating history in a market that's changing super fast.
And one more thing, governance. The S1 mentions the multi-class stock structure,
Right. Class B shares get 20 votes each versus 1 for Class A. This gives the co-founders exclusive voting control, as the S1 puts it.
meaning they basically control the company's direction, and it makes takeovers or big shareholder revolts much harder.
Pretty much. It concentrates power significantly.
Okay, so that's a deep dive into Chime's world according to its own S1. Target market, the free model fueled by interchange, driving engagement and product adoption, the tech backbone, the path to profit, and some pretty hefty risks.
A really detailed picture, warts and all, as you said at the start.
Here's where it gets really interesting, bringing in that context.
Mm.
Chime mentioned SOFI as a competitor, so looking at SOFI's 10K, how does their approach look different?
Well, SoFi's 10K talks about their strategy using this phrase, the financial services productivity loop.
Productivity loop. Sounds like they want you in their ecosystem and using everything.
Yeah.
A sort of financial super app idea.
That's the gist, yeah. Well, Chime seems laser-focused on that primary banking relationship with everyday Americans. SoFi's documented strategy is broader. Offer lending, saving, investing, spending. Get someone in for one thing, then cross-sell them more.
More products, ideally leading to more revenue per member and lower acquisition costs down the line.
That's the theory laid out. And their product list in the 10K definitely reflects that breadth.
Yeah, it seems much wider than Chime's core offering. What does SoFi list?
Things like SOFI Money for checking savings, SoFi Invest, their credit card, a whole loan platform business including services for other companies, and a SoFi Relay for personal finance tracking. It's a much more comprehensive suite.
So a different philosophy. Chime going deep and focused, SoFi going broad and integrated. How do their financials stack up just based on the recent profitability point in the filings?
Well, the SoFi 10K excerpt notes they had net losses before Q4 2023. But like Chime, they highlight hitting profitability recently. They report achieving net income in Q4 23, and for the full year 2024 specifically, $498.7 million net income in 2024.
Interesting. So both companies, taking different strategic paths, have highlighted reaching profitability in their recent filings. Suggests maybe the market is maturing, or at least these specific models are starting to bear fruit.
Could be. It's definitely a key milestone both are eager to point out. And looking at SoFi's risks in their 10K adds more color, too.
Similar risks to Chime or different ones?
Some overlap, definitely. Macroeconomic conditions, credit risk, relying on third parties, those are common concerns.
And regulation. The CFPB boogeyman.
Oh, yeah. SoFi mentions broad regulatory scrutiny, too, including the CFPB, UDAP concerns, and specifically calls out scrutiny around banking as a service, or BOSS, which relates to their acquisitions like Galileo.
Ah, so while both face CFPB risk, the specific regulatory headaches might differ because SoFi's business is broader. It includes things like acquisitions and providing services to other fintechs.
Exactly. That breadth and the integration of acquired companies like Galileo and Technisys bring their own set of risks related to complexity and integration, which you don't see highlighted in the same way in Chime's S1, given Chime's more organic build.
This comparison, just based on their own filings, is super helpful.
Yeah.
So stepping back, What does this all mean for you, the listener, trying to understand this space?
Well, based purely on these documents, you've got two big players tackling consumer finance very differently. Chime's going deep with everyday Americans, focusing on that low-cost primary payments relationship, powered by interchange and specific liquidity
Ah,
tools.
very focused.
While SOFI, according to its 10K, is building that broader productivity loop, aiming to be a multi-product financial hub, using acquisitions to accelerate that. Distinct strategies.
But facing some common headwinds?
Absolutely. The documents show shared challenges, that critical reliance on bank partners, the looming presence and uncertainty around regulators like the CFPB, and the constant need to manage credit and transaction risks effectively. Those seem like table stakes risks in this sector right now.
So, for you listening, comparing these filings gives you clues. Does Chime's deep focus on one segment with this simple, low-cost model seem like a stronger bet against those risks? Or does SoFi's diversification across more products and services seem like a better way to navigate? The S1 and 10K lay out their respective cases.
Understanding how they frame their own strategies and risks is key to making sense of the whole fintech landscape.
Right. So, quick recap. We dove into Chime's S1, saw their target user, the interchange-driven revenue, the focus on product adoption and retention, the tech efficiencies, that recent turn to profitability, and the big risks, especially bank dependence and the true lender issue. Then we pulled context from SoFi's 10K, as cited by Chime, showing a competitor with a broader strategy, also recently profitable, but facing similar and different regulatory and operational challenges due to its model.
A tale of two fintechs, straight from their own official filings.
Okay, so here's a final thought for you to chew on, based only on what these documents tell us. Given Chime's sharp focus on everyday Americans and building that primary low-cost relationship versus SoFi's documented strategy of a broad productivity loop built partly through acquisition, which approach do these filings suggest might be better positioned to thrive amidst the intense competition and regulatory pressures both clearly acknowledge facing in consumer finance?
It's a great question to ponder, using their own words as the guide.
Thank you for joining us for this deep dive.
Until next time.